And welcome back to another edition of Your Wealth and Beyond. Matthew Sullivan, welcome to the podcast.
Thank
How
you.
are you this morning?
Very well. Thank you for having me on.
You know, we were just chatting about your beautiful background there and how it brings out your eyes. So thanks for putting that together.
It's quite I was just explaining that we've just moved house and there is a large sort of pile of boxes behind this. So I thought I would spare your viewers' eyes the mountain of cardboard behind me.
So, Matthew, the podcast is really built on building wealth and most importantly, finding purpose. So as we go today through your story and how you, as a serial entrepreneur, but, kind of have a focus on helping people unlock one of their most powerful assets, which is their home. First, I want to start, what gets you up in the morning? What is your passion as here where we are today in 2022?
Well, I think it's creativity. I think if one goes through the same routine every day, it gets stale. So for the last 4 years, I've been building QuantmRE, and we're at the point today where we are literally days away from launching a very important component. And so really, over the last 4 years and way beyond that, it's really just been about having something creative to do, something that where you can see an outcome at the end of the day, where you've actually built something. And not all days are fantastically productive, but it's just that concept of making one first step of actually getting to the end of the day and saying, I think I've actually taken this thing a little bit further forward.
And growing up in South London, correct? Was that a passion of yours as you grew up? Were you always creative and thinking about how you can fix things?
Well, it was more of a necessity actually, because I just discovered at a very early age that I was probably rather unemployable. So having to, I think it was two things really. I started my sort of career as an entrepreneur in the late 90s. It really, at that point, it sort of comes alive where you haven't got the constraints of working for someone, but it's this sort of dual-edged, double-edged sword where, okay, you've got the freedom and the creativity, but you've actually, have to live or die by your own success. But yes, I was, born in the UK, brought up, went to school in London, and spent, most of my life. Moved to the US about 9 years ago, but for the bulk of my career, it was really just building businesses and creating something that was successful. That's the important thing. I mean, you can create stuff, but as they say in Lancashire, it doth butter no parsnips if it's not successful. So there's that other part.
And one of your experiences in your working career is you had a chance to work with Sir Richard Branson. So walk us through a little bit of what that looks like.
Yeah, that was a really interesting story. So we worked as a small corporate finance outfit in Kensington High Street, which was literally a stone's throw away from Camden Hill Road, which is where Richard's empire was built, which was in Notting Hill. And my boss at the time, Rory McCarthy, it was a small outfit, had this dream to fly around the world in a hot air balloon. But unfortunately, one of his sponsors, Kodak at the time, pulled out at the last minute. And we had happened to have bought a majority interest in Lindstrand Balloons, which is this hot air balloon manufacturer, which every corporate finance company does. And so Rory wrote to Richard and said, we want... I've always wanted to fly around the world in a hot air balloon. It's the last great uncharted sort of, expedition. I think it's ideal for you. Would you like to come along? Would you like to be a pilot? And he wrote back and said, dear Rory, why not? So we started off our relationship with Richard by, being the instigators and the builders of the Virgin Global Challenger, which was that, hot air global circumnavigation attempt. I'm not sure if you still remember that, but from there we ended up being pretty close to him and worked with him for a number of years in his corporate finance as part of his sort of corporate finance team.
Yeah, so seeing and learning from one of I don't know him personally, but the book, just learning from somebody who is a risk taker, who's an adrenaline junkie, but really, I think from his success has been delegating and letting people run and be leaders and let them do their thing. So I'm sure that was quite the experience to work with him.
And it was, but and you're right. I mean, I think many of us are driven by adrenaline. But one of the things about Richard that I really took away was there is a very deep, measured consideration of things, and it's a view of life that is actually very different. It's a view of possibilities, and I think a lot of the great leaders share this, where you're not constrained by how you've been brought up or your circumstances. You really just have the ability to see way beyond that, and that takes an enormous amount of vision, but also being able to deliver on those things takes an enormous amount of hard work and dedication and skill and expertise. So none of it's luck. So everything that Richard's done, even though he has this, I think, this persona of being, as you say, adrenaline junkie, and it's behind the scenes. It's very different and very measured, but still enormously inspiring.
Yeah, calculated to the highest degree, but we don't see that behind the scenes. That's interesting.
Yeah, and some of the guys that we worked with, and this is a few years ago, but they were some of the smartest and scariest people you'd ever met in terms of their intellectual capacity and their ability to make decisions. So that was some of the stuff that you take away. The fact that these people are actually very, very smart.
Yeah, and it puts you on your A game. You got to be always, every day, bringing it to the table and being the best you can be. So you've, over the years, again, we're not really working for anybody, but, being an entrepreneur, I'm an entrepreneur, we have a special gene, I guess, that makes us a little crazy. But as we dig in today on your latest venture, which is an interesting component to the real estate sector that I had not really even heard of before we started digging in and learning about you and the company. So when we talk about home ownership and residential, here, at least in the States, it is one of the largest assets that people have, and it's usually locked up. So that's a problem, right? So let's just talk high level of you starting QuantmRE and, coming up with a new ability for people to unlock this equity from the standard way. Where did this come from? It's so relatively new, but it is inspiring on how it could change a lot of the landscape here.
Thanks. Yeah, no, it's something that I came across very early on. When I moved over here, one of the first things I did was to set up a crowdfunding company because at that stage, the Jobs Act had just been passed, and that enabled you to create online platforms and offer online deals pretty much for the first time. So that was the beginning of what has become, as a sector, and incredibly successful. So online investing, I think everyone would agree, is now a multi-billion-dollar industry. And real estate is one of those assets that I always wanted to get deeply involved with, never really managed it in the UK, but was determined to become, to be very involved and immersed in real estate when I moved over here. So trying to combine those two together, and the real problem with real estate is finding deals. And so, and hopefully this won't be too long of an answer. But the biggest challenge is if you're trying to do real estate transactions online, finding the deals. And if you're doing, if you're owning property or if you're lending money, you've got to manage those loans or you've got to manage those properties. So the infrastructure that you need to build to be able to have a very large portfolio of deals is significant. And it's the antithesis of the platform, because the platform is designed to be very light and flexible and fast moving. Yet behind the scenes, you have all of this clutter and all of this necessity to be able to deliver. And I stumbled across this concept of buying into the equity of homes that are owner occupied, where you don't actually own the home. What you do, though, is you have a construct or an agreement that enables you to benefit from the equity appreciation. And really, for investors, that's all you really want. You want a share of the appreciation. And if you can avoid all of the costs and friction associated with property ownership, that's ideal. So, and this was about 7 or 8 years ago. And over the last few years, this concept of home equity agreements or home equity investments has increased significantly in terms of the adoption by institutions that want to invest in them, and also their acceptance as an alternative for homeowners to unlock the equity in their home. Because, as you say, it is a relatively new concept, but actually it's about a decade old now. And I would say this year we're expecting over $1 billion to be created or to be invested in home equity agreements across all of the companies in the space.
Okay, so this compares, the old the way that most of us know to get equity out of a property. We're either going to look at doing a refinance, we're going to do a home equity line of credit, we're going to do a cash out refi, or even the newer reverse mortgage, right? And so we've got
all debt products, all different flavors of loans.
Then let's talk real high level here. What is the beyond? We'll talk about the investor and why they would do it. But me as a homeowner, why would I go down this route versus the quote unquote normal route of debt?
It's an option. So the first thing is, this is now an option that you didn't have before. So in the commercial real estate world, you've got all sorts of funding options. You've got debt, senior debt, junior debt, you've got equity, you've got mezzanine financing, you've got shared appreciation mortgages. You've got all these different flavors of equity and debt and combinations of the two. If you're a residential homeowner, you're restricted to debt. So what we're doing is we're bringing commercial style financial applications to residential homeowners. Now, your question is, why would I do it? Now, with a loan, first of all, you've got to qualify for the loan. So whether it's a cash out refi or a HELOC, you've got to have a credit score that meets the requirements. You've got to have a debt to income ratio. You've got to have a salary. And also, if you take on additional debt, you've got to be able to meet those monthly payments. So you're increasing your monthly payments just to be able to borrow money to access your equity. Now, your equity is an asset, but by borrowing money, you're not getting your hands on your asset, you're leveraging your asset, and you're increasing your debt. Now, what we offer is an investment. So we're not lenders, we are investors. And what we say is, in exchange for a lump sum that we invest with you as the homeowner, you agree with us that in the next 10 years, at the time, when the contract comes up for, when it comes to the contract end, by then you will pay us back the amount that we invested, together with, a share of the appreciation or potentially depreciation in the home. So what we're doing is we're investing with you. We're not asking you for any monthly payments because it's not a loan. It's a trade. It's an investment where we say, here's our investment. Our bet is that your property will go up in value, and that when you come to refinance us out, or when you come to sell your property, that we will get back our investment together with some of the appreciation, which will give us a solid return on that investment. And to answer the final piece, you would do this because we are underwriting this investment based on the value of your property, the amount of equity that you have, and where your property is. We're not necessarily underwriting it based on your FICO score or your income or your debt to income ratio. So that's why we can help people with the credit score as low as 500, sometimes even lower. And there are no repayments ever during the term of the agreement. And we can help people find capital and unlock their capital that simply may not have been able to succeed in applying for a loan, or may simply not want to have those extra monthly payments.
So it's a contract, it's an option agreement. So ultimately, you're not taking any position in the home. There's no second position.
Correct. Well, we do. We're not taking ownership, but we protect the agreement with a lien on the property. Okay. Those are two very different things. Obviously, I think we all know that, but it's a bit like a mechanics lien. So a mechanics lien doesn't take ownership of your property, but they still have, there's still a cloud on title. So we don't take ownership in the same way that a HELOC is represented by a lien. We have a lien. The language is very similar to a trustee, but obviously it's not a loan. So it's very similar structure, but we don't own the property. And that's the very important point. We don't have there's no due on sale clauses that are invoked because of this. You don't run the risk of having your property tax revalued. So there's a number of benefits. And also, most importantly, it doesn't appear as debt on your credit report. So you can use this money to pay off very expensive credit card debt, or to use it as an investment, or to do anything you want with it.
And so let me get this. So if you're going after somebody, potentially this is an option for somebody who can't qualify for that, right?
Yeah.
So the refinance, or we'll get into the or in a second here. And so ultimately, you're given it's normally a 10-year window that they have. Okay, so they're either going to sell the house in that time frame. Hopefully, it's appreciated. You, as the investor, are getting paid off. Until that time, the investor's getting nothing. Right.
Well, the investor has an asset, and we can talk about that, because what you're doing is you've got an equity asset. You don't have a cash flowing security. You have a cash flowing asset because it's based on equity. So yes, you as the investor, but we can talk about why this is really attractive to investors in a moment.
So let's walk through on the homeowner side first. So 10 years is up. I still own the property. Most likely, it's gone up in value.
Yes.
I still have debt on it, potentially from the original, the loan. Now, you want to be paid back, or your investor does. What happens in that 10th year if I can't refinance?
Well, the important thing is that the agreement is due. So if you can't refinance, if there is sufficient equity in the property, then we can roll the agreement over and run a new 10-year agreement. So effectively, we would pay off the first agreement, and in most cases, based on historic performance, there will be enough equity to be able to take out another agreement that takes over the obligation under the first agreement and then runs it for another 10 years. At which point, the original investor will be cashed out and the new investor will come in.
And so in theory, then you guys, to make this work, it's securitizing a lot of these type of these type of investments.
Yes. And again, that's really one of the biggest challenges of this asset class is it's potentially illiquid for 10 years. But 10 years is not too long of an investment horizon, particularly for real estate. But it doesn't cash flow either. So that's what, those are the two big problems that we encountered very early on when we set Quantum up. And really, those are the problems that we set about solving with Quantum at the very beginning. So we said, okay, we know this is a great asset class. And we'll talk in a moment about the returns, the downside protection, and why now this is one of the best real estate investments that I can think of. But the biggest challenge is, someone says, well, if I don't get any cash flow and I have to wait 10 years, how do you solve that problem? So we've built an exchange, which we're going to be launching next week. And what that exchange does is take each one of these home equity agreements. We use blockchain technologies to fractionalize each one of those agreements into 100ths. And then we offer for sale the benefits of that agreement to smaller investors. So an investor could come in and fund a $200,000 home equity agreement, and then they can sell some or all of their interests in $2,000 chunks to smaller investors who want to buy into the potential equity appreciation of high quality homes that are not for sale. So that gives your initial investor a return on their investment, gives them their money back. And in the marketplace, smaller investors are able to buy into home equity agreements, which are still very much the preserve of large institutions, multifamily offices. They're not available to Main Street investors.
And with this, so you're kind of bringing your crowdfunding venture that you've already, you've 7 years ago you created, bring it into this new world. Are these accredited? Are they going to have to be accredited investors?
To start with, yes. But towards the end of this year, because they're securities, you need to be accredited. But it's a self-accreditation process. Towards the end of this year, we will be applying for a different type of exemption, which is called Regulation A+. And that allows non-accredited investors to invest. And it also frees up their ability to trade their interests without any lockup period. So our initial launch will be to accredited investors. And then later on this year, subject to qualification and approvals, we're aiming to launch this marketplace to a much wider non-accredited audience.
So back to the actual equity contract. So in today's environment, I can, and just learning about this through our talk today, I can see it as it becomes much more beneficial the way you're presenting it for two purposes. One is obviously a higher interest rate environment means if I'm going to do a HELOC, my HELOC now is going to probably be 6.5%, a lot different than when it was 3%. Secondly, I have this 30-year fixed mortgage at under 3%. We know that a lot of the reason the inventory out there and here in Scottsdale and Phoenix, it's still relatively, it's so small. We have no inventory. It's getting better and better, but that's because people are like, well, I've got a 2.75% mortgage. I can never leave my house. Yeah. So what would I be correct in that assumption that we don't want to refinance our debt because it is an asset for the homeowner? Now, your way, equity contract, I can get that money to me in a lump sum without having go beyond the red tape and the cost. Now I get to keep my current fixed mortgage, my fixed debt, which is almost in theory like free money.
Yep, that's exactly what it is. It is an alternative, additional way of accessing capital. Now, if you are a savvy investor, you will be able to make more as a return on the investment that it's going to cost you from us. So that's the other way of looking at it. Your asset, the equity in your asset, if you are unwilling to borrow, which obviously why would you refinance at 7% when you're locked in at 2.75? So, that doesn't make sense at all. Yet your equity is sitting there, it's appreciating. We allow you to access that equity. There's obviously a cost of that capital, but there's no servicing cost from your perspective. There's no debt implications. So it doesn't affect your ability in terms of, if you want to use it to buy another property, that's an equity down payment. It's not treated as additional debt from your perspective. So there are benefits. And what you're doing is you're diversifying out of your primary residence. And this is also available to non-owner occupiers. So if you have rental properties that are owned in your name as opposed to a company name, we can also work with rental properties.
So let's, for my listeners, let's go through a real world scenario here of how this works. So I've got let's say I've got a house worth $500,000. I've got $100,000 debt on it. My mortgage payments are relatively small, so I'm not going to refinance. But I would like to get $100,000 out of the property, or I'm sure there's a percentage, right? You're going to look at that to equity, but in this case, does that 500? We have 400,000 of equity. Would we be able, based on, I know there's probably other requirements, 100,000, right? So your investors, you guys come to the table to the homeowner and come up with the equity contract, and the homeowner receives $100,000, right?
Yes.
In the bank. Now, am I simplifying?
No. Yes, exactly. Your numbers work perfectly. And all I was going to say is that is, in some respects, that is actually as simple as it is. It really is. We're looking at your property. We're looking at the debt. You've got plenty of room there. So, and we can go up to 25, 30% of the current value of the property. So, $100,000 is 20% of the current value. If we add that to your existing mortgage, it's less than 75% loan to value. It's going to be about 40%. So you're well within tolerance.
Okay.
The way that the agreement works is, in exchange for 20% of the current value of the property, you agree with us that when you sell or refinance, which can be any time in the next 10 years, you will pay us 32% of the value of the property at that time.
Where did that come from? That 12%, is that based on?
It's 10%. For every 10% that we invest, we get 16% of the value of your home. So in other words, if we invest 20%, we get 32%. It's a discount where we're buying 32% of the future value in exchange for 20% of the current value.
And then and I know we can't give tax advice per se as a owner of an investment advisory firm. We do look at tax strategies, but this $100,000 that I received as a homeowner, I am not taxed on that when I receive.
That's correct. That's correct, because it's not. It's a future-based transaction, so it's not income, and there's no capital. Excuse me. The capital gains tax calculation. And this is actually quite interesting because it is a very tax efficient way of receiving capital. If you were to refinance us or pay us back by selling your property, and if you had a capital gain due at that time, you can reduce your capital gains tax liability by the cost of our capital. So in other words, let's say that your $100,000 cost you $150 in total to include the original 100. That $50,000 extra cost of capital can be used to reduce your capital gains tax bill. So in other words, what you're doing is it's a tax efficient way, and that means that your real cost will be lower. So in terms of what you're paying as a cost of capital, if you factor in that capital gains tax benefit, your real cost of money is lower.
And you had mentioned earlier, with regards to if I have a current debt, that this will not subject me to a due on a clause where I now lose my mortgage.
That's right, because you're not selling your property. You're not changing anything from the title perspective. We sit in a junior position to the existing loans. So we're not having to go to your lenders asking them to swap places or do anything which is likely to upset them.
And I guess on your guys' side, because I could use that money for anything. I can invest it in another business. I can invest in the market. But I guess selfishly for your side, you would want them to invest back in the property as a remodel, because that's going to increase the value maybe a little bit more, 2 or 3 times than if somebody took that money and didn't do something with it, because you're getting, in a sense, like a business now. This house becomes more valuable because I put more money into it.
Yes, you're right. But also, that's not terribly fair from the homeowner's perspective. So we are probably, I think, the only company that gives a homeowner an allowance. So if you do invest more than $30,000 of the capital that we invest, if you invest that back into your home, when you come to settle agreement with us, we will factor that in, and we won't count that towards the additional value of your property. So in other words, you'll get the benefit of that, and we don't. So that's I think fair. There are other companies in this space that have a different approach, but that does give you the incentive to put that money to good work. But again, from an investor's perspective, we're talking about the ideal steward of their investment. As a homeowner who is still, you've still got 60% equity, you've still got a fair chunk of equity. You're still very involved in your property. So for us as an investor, that's an ideal partner to have.
I mean, I guess it more closely resembles a reverse mortgage. I know those are a little bit complicated, a little bit more. They're obviously expensive, but I'm just thinking, like what happens at the end of the term is that now that client didn't have the payments. They have to sell or they die, and the bank is eventually getting paid the difference of what the home has gone up and what the mortgage has gone up to. Would that be safe to assume we're on the right?
It's conceptually it's similar because the payment comes at the end, but that's really where the similarities end. So a reverse mortgage, again, it's a debt product. So if the value of your house goes down, your loan and the interest that you owe is still there. So that means that the bank is going to want more of your equity if the value of your house goes down, because you've still got to pay that loan back. In our case, the amount you pay us is directly related to the value of your property. So if your property goes down from 500,000 to 300,000 because there's a market crash and you sell at that point, we would get 32% of 300,000, which is actually less than the amount that we invested. So there is a risk on our side, and that makes it more attractive to a homeowner. Also, if you decided to move out and rent your property with a reverse mortgage, that wouldn't be allowed. And also, with a reverse mortgage, you'd have to replace your 2.75% 30-year fixed, fantastic mortgage with a far more expensive reverse mortgage because you can't have two mortgages. So there's all sorts of restrictions. It's much more expensive.
What about, so I die. What happens then? Is there a due on death clause?
There is. So the at the death of the last surviving owner of the property that's a signatory, then that triggers the repayment of the agreement.
What about, so I've got a lot of friends out here who own, 5 homes, 30 homes, et cetera, yes, right, in different LLCs, but over the years, they've securitized that. They've got, yes, we're going to bulk these 10 and I'm going to get this debt against it. Yeah. How, if I have 10 homes, how would that work? And these are rentals and I'm not living in it. Can I look at this as an option to get money out of my properties?
Yes, with certain restrictions. First of all, there's a maximum that we will invest, which is $500,000 per person. So these are designed to be personal contracts.
Got it.
Secondly, your property has to be owned in your name as opposed to a company name. And the reason for that is that, when you move, if the property is owned in your name, you'll transfer the property to the new owner. If it's owned in an LLC, normally you'll just transfer the ownership of the LLC. So that means that no one's actually selling the property. So there are a number of reasons why we can't work with properties that are owned in companies, but we can work with rental properties that are owned in individuals or natural persons' names.
Interesting. Okay, so let's talk about the market environment now. Not saying that an 08's happening with the real estate. We're definitely seeing changes. It's becoming more of a seller's market. So we're seeing price reductions. So for you guys, and I know the investors we have a lot of diversification in the loans, et cetera. So we have a pullback in the market. There's a 20% pullback. And although we have a 10-year window of selling, what happens if you get a rush of people that are selling in the next 3 to 5 years? Your investors, I guess, know that there's a potential for losses here, right?
One of the things I said earlier was that I wanted to explain why I think that this is one of the best real estate investments for the current market. And to go back to your example, where we've invested $100,000 with your house, which is that's 20% of the current value.
Yep.
But you've agreed to, when you sell, you've agreed to give us 32% of the future value. So we're buying, $160,000 worth of value for $100,000.
And it doesn't matter the time, whether it's 2 years or 10 years upon that happening, that is when it's due to you based on the value of the home.
Exactly. But what, again, we do for the homeowner is we cap the amount that we can earn. And we normally cap that at around 18.5% a year. So if you sold your property next year and you sell it for the same amount, $500,000, then, we wouldn't want $160,000 at the end of 1 year, because that would be too much. So what we would say is that because you've had it for a year, what is the lowest figure? Is it 16% or 32% of the current value? Or is it the amount that we invested plus the equivalent of an 18.5% return? So if you sold your property after a year, you would pay us back $118,500, not $160,000. Or 32%. But again, coming back to why this matters in potentially a falling market. If your property value falls to $400,000 and you sell, as a normal investor, I would be taking a loss. I bought your property at 500, you sell it for 400, I'm taking a loss. With a home equity agreement, if you look at what is 32% of 400,000, it's about 120,000. I'm still 20% up. Because I gave you 100, you give me 120 back. Even though your property has gone down in value by 20%, I'm still up 20% on the contract because, as you said earlier, it's an option agreement, but there is a significant amount of in-the-money element that protects investors in a down market.
Right. So the investor is safe. Where this would really affect and be an awful investment or an awful option in that scenario, the homeowner paid a lot for that capital, right? They basically got hit in that scenario where they, X and now it's worth Y, and they had to pay you Z, or the investor back Z. Then it became a lot more costly capital than them refinancing or taking on, the additional rigmarole of getting regular debt. So that's kind of the rolling the dice if property values go down, because I'm still on the hook to pay you guys the agreed upon amount.
Yeah, exactly. But again, I think we're looking at it through different lenses. So if you look at it through an investor's lens, this is a great opportunity to buy into, first-class residential homes that are not for sale with significant downside protection. So even if property values fall horrendously, I'm still in the money. I can still make a positive return.
100%.
And there's nothing else that we know. From a homeowner's perspective, the amount goes down that I owe. So even though my property goes down in value, that means I owe less. Now, if it was a loan, I'd still owe the same amount. So it actually benefits the homeowner as well, because the amount they pay us back is less. But even though it's a lower payment, the investor is not getting penalized. So the homeowner, this is more expensive than traditional debt, but there are so many other benefits.
Yeah, and I would assume to look at this, you would, things can change, but it would probably make sense for somebody who's, me as a homeowner, to do this. I'd want to probably say my goal is to be in the house for at least 5 years. It wouldn't be, if we're looking to sell in 2 years, just like with anything else, it's like, let's hold on and not do anything, because that's just not going to make sense.
But what some people do actually is they use the money to rehab the home and add significant value. So you force the appreciation, and the amount that they get back from the sale proceeds is greater than the cost of capital. So it is a very useful tool in that sort of short-term scenario as well.
This is definitely very interesting. Most of the majority of the population, and you think even advisors and CPA, we just haven't heard of this. What's the reason? Is it just because it is so new, or is the mortgage industry?
Yeah, it is that. I mean, if you look at it's new, and also it's different. So in other words, if it's a new type of debt product, like when HELOCs first came out, there's that education process, but people are sort of familiar with HELOCs because it's a loan. And you've got the two challenges of it being a different type of product. It's equity-based as opposed to being a loan. So people are trying to get their heads around the fact that there are no monthly payments, and therefore it's too good to be true. So there's that sort of change of mindset that needs to happen. But it is happening because it's being driven by people who need capital and who cannot borrow money or just don't want to. So there's that need that's driving that sort of exploration. And also, you're right, it's only been around for about 10 years. For a financial product for homeowners, that's a drop in the bucket. So I think over time, as there's more demand, and particularly high interest rate environment such as this really does drive, the need is still there, but debt products aren't going to be able to service that need. So, our time is now, I think, certainly for home equity agreements.
And with you being, a competitor of yours, of course, is the Goliath and the mortgage industry, the banks. Have you, as this becomes more popular and more money flows into it, have you started seeing that landscape where they're getting notice of you? Like, is it, you're a threat to them?
It's positive. We're not a threat, because what we're doing is we are deleveraging the homeowner. So if we're deleveraging the homeowner and we're giving the homeowner more cash without additional monthly payments, we're putting them in a stronger position, and we're making it more likely that they will be able to continue to service their existing mortgage. So that avoids bankruptcies, that avoids having to reschedule their debt. And if you reschedule a loan, there's all that cost involved from a mortgage, there's that additional risk. So by tapping into the equity side, what you're doing is you're bringing investors in to an entirely different part of the property's capital stack, creating liquidity, which benefits the homeowner. And if it benefits the homeowner, that means that they can continue to pay their obligations. So that stabilizes the environment from an economic perspective, rather than, creating, the potential for, economic distress.
And the growth trajectory, what are you predicting in, let's say, 5 years of capital that will flow into the equity contracts?
I think we're seeing unprecedented growth. Well, I know we're seeing unprecedented growth at the moment, and that is because of two factors. One, the ability for us to originate these deals is increasing, so there are more and more companies that are out there that can actually create these deals. And also the return profile for investors in the current market is significantly beneficial, attractive, and advantageous. So all of that from an investor side, there's lots and lots, there's billions of dollars of capital looking for these deals. And also it'll grow because it solves a real problem for homes. So this is not a nice to have. This actually fixes a major problem. If you can't borrow money and you've got equity because your home has shot up in value over the last 2 years, here is the only way that you can get your hands on that and put it to good use, which for many people can really make a difference. So there is that real sort of benefit to the homeowner as well.
And I assume that some may use it to, if they've got a variable rate on a HELOC, et cetera, that maybe they'll use it to pay that down.
Yeah, we do. And in a lot of cases, we have people that pay off their HELOCs. They just are afraid of, where the rates are going to be in a year or so, particularly if they're resetting. And, they're at the mercy of the market. So people can use it to pay off all sorts of debt, credit card debt at 20-something%. I mean, that disappears because there are, the benefit of that going away, is important, and that makes a difference to people's lives. When that debt is gone and they haven't got that sword of Damocles hanging over them every month, that makes a real difference.
What is your 10-year plan? What's your vision for Quantum? As a company, where do you want to be?
Well, we see this. I mean, if you look at the huge growth in mortgage securitization and trading, we want to be the largest global platform for the trading of equity in residential homes. So that will involve our ability to originate transactions, but we want to be the platform where you can buy and sell this unique asset class. You can't do it at the moment, but there's literally, there's literally trillions and trillions of dollars of homeowners equity that's available. So as an asset class, it is this enormous untapped asset class.
So you're having fun. You're trying to change an industry.
Yes.
And
build a new one. We're adding to. That's the thing. We don't want to change it. We're trying to change the mortgage industry. As you've got more chance of drinking the ocean. But we're adding to it. We're creating something new. We're solving a problem and creating a new asset at the same time.
And how is as we end today? Your leadership. What have you learned over the years for you to lead your team and look to create an industry on its own? What are some of the successes you've had and even some failures?
Well, I think most of the failures come from trying to do it all yourself, and I think I figured out that the things that I'm good at are primarily bringing people together and synchronizing or assembling, people and products. The vision is there, but to try and do it all on your own, I think, is always a fatal mistake. And so I think you need to be coachable. I think you need to say, okay, this is my vision. This is what I see. That doesn't change. But you need to be able to take the advice from people that bring value at certain different stages and not be pig-headed about this is, my way or the highway. So I think, all of the places where I've gone wrong in the past is where, you mix vision with execution. And okay, you're probably quite good at executing stuff, but there are people that are just much better at it than you in certain respects. People that have just a different view of life that you really need, like underwriting, for example. We work with some of our guys they have that clear digital perspective on life that makes them perfect underwriters. And I don't share that view. So the team is so important, a good team, and relying on them and giving them the ability to help you grow the business.
And do you have a mentor yourself? Do you work with a coach to help you?
I don't, but I'm very lucky in the sense that the people that I have working with me, I take advice from them. I don't have a specific coach as such, but every day it feels like I'm learning, I'm listening. If the answer is no, we don't want to do it this way, or we should be doing it that way. And we have this constant sort of conferring process of where are we going, what have we built, is this, are we on track? So there's a lot of that process that happens on a daily basis, and I think that is effectively the same sort of the same effect.
Wonderful. Well, the last question is the most important. I'm going to be in London next week.
Yes.
Any two restaurants that you recommend? I'll be in near the Soho. I'm saying at the Cafe Royale, but so near.
I'll go to the Ivy. I haven't been there for years. I'm sure it's still there, but the Ivy is the place where I haven't been there for like 9 or 10 years. And the Gavroche, that was always a great place. But also, if you go round the back of on the other side of the road to Harrods, which is not too far away from Soho. Yep. There's some fantastic little places there, actually. But
awesome. What you moved about 7-8 years ago. Why'd you move across the pond?
And I combination of personal reasons. I got married, got 4 children, and just big change of circumstances over in England, and just serendipity, I think.
Yes,
just a combination of all these things came together.
Beautiful. Well, I've really enjoyed our conversation today. You've opened my eyes up, and as a financial planning firm,
it's great speaking to you. Thank you so much.
Yeah, you're doing some good things. So I'm excited for what this industry, that you're building. We'll be definitely following you, and listeners in the show notes. There'll be plenty of opportunity to follow Matthew and his company, and to be able to reach out. And I'm sure we're going to hear much more about this as the years go on. So Matthew, thank you for spending some time with us here on the Your Wealth and Beyond podcast.
Pleasure is mine. Thanks very much.
Been a pleasure. All right, listeners, stay tuned for later this month for a brand new episode of Your Wealth and Beyond. Happy planning, everybody.